Hello and welcome to this discussion on the price increases that we've all been seeing in our daily lives. Inflation is hitting us all, so let's try and explain what's going on behind the scenes, where this money is going, and what we can do about it potentially. Inflation does not have a simple cause like printing money, or low interest rates, or any of the other sort of simple monetary explanations that are used far too often in the media. Inflation is partially naturally occurring, but it's also partially a calculated decision made by wealthy people and monopolistic firms that can influence price levels with their enormous economic power. Let's break it down a little bit. Often, inflation is broken into two different places where it can come from. Cost push inflation, which is where the costs of materials, labor, debt have already increased, and some of these costs are reflected in a price increase. This is seen as a supply-side decision. Demand pull, or as I like to call it, profit-seeking inflation, is when firm owners believe that there is inelastic demand for their products, meaning that even if they increase prices and lose customers, they will still make more profit overall. This is sometimes seen as demand-side inflation, as if we're the ones bidding up the prices, but the decisions are all being made by supply-side actors like corporations. Whether they produce enough to meet demand, or, following that, increase the prices, are both decisions that are made by corporations. So, let's not pretend that there's some mystery as to where the price increases are coming from. So, monopolistic pricing is where most of the demand pull inflation comes from that we deal with. Corporations exist on a spectrum between price makers, meaning that they influence the overall price of the market, and price takers, meaning that they have to accept the price that the market hands down to them. The more control that corporations have over any market, the higher that they can increase the prices without losing demand to competition. The main argument that you'll see against the idea that business owners control the price level is that they have competitors who will steal all their customers, which assumes that all corporations are price takers. However, even neoclassical economics, a super conservative, pro-free market form of economics, acknowledges that this only happens in perfect competition, a scenario in which there are no barriers to entry for new corporations, and established corporations have no patent protections, branding, or any other advantages over new competitors, which is obviously not what's going on. Over here in reality, nearly all markets are in what is called a form of monopolistic competition, oligopoly, or cartels. So the general price level in that market is set to whatever suits those people, the monopolists, whether it's the oligopolists, the cartels, or the monopolies. All of their competition are the price takers. If they've set the prices low, then the advantage of this to these established corporations is that it drives away new or small competitors who can't reach the economies of scale of these big businesses. Think about how Amazon has just devastated small businesses across America. If they set the prices high, then it's because big business is not worried about the competition, because they recognize that the barriers to entry have been placed too high to compete with established corporations. Now you might think, oh, well, regulations cause that. Actually, it's almost never regulations. It's usually that the cost of setting up a new one of these businesses is so prohibitive. It costs millions of dollars to set up a new factory and start competing and start advertising and doing all these other things. So an established corporation already has all of these advantages. This is why we don't have competitive markets. This is when corporations can make the most profits, and this is the market situation that they seek. This is considered the ideal. Or full monopoly is considered the ideal, but then they get worried about being broken up, although they're not as worried about that anymore. The next one is expected inflation theory, and this is often why you can see inflation gaining momentum. As people expect more inflation, they preemptively increase prices, increase their buying habits, and increase their wage demands. Historically, public expectations that inflation will be higher in the future encourages many businesses to preemptively increase prices. If they do not, then they will be less profitable than their competitors, followed by having to restock at the higher price. Consumers notice that prices are rising and begin to preemptively consume goods to make their money go further. This means that the demands on the market do not decrease, like capitalist theory suggests will normally happen during a price rise. When inflation is expected, workers have to demand higher wages or they lose purchasing power. Since labor is a cost for all businesses, this gives them a cost push reason to increase prices further. Workers, however, have to actually have the bargaining power to gain these wages, which they often don't in non-unionized environments. Supply shock is often the most common because it comes as a surprise. Sometimes a natural event will shock supply of important goods and resources, such as every disaster you've ever heard of, where water becomes a precious resource and price gougers take advantage of this. That is sort of how market dynamics work in a crisis. Or, a more recent example, a pandemic might shut down meatpacking plants, simultaneously causing the price of meat on the store shelves to go up, while causing the price of animals to go down at the exact same time, because all these farmers now have to expensively stock all these additional animals that they normally would have been able to send to a meat packing plant. And so they actually are selling their animals to these meat packing plants for even less. Meanwhile, on the store shelves, you see higher prices. So it's pretty complex how it can work. Sometimes a supply shock can actually decrease some prices and increase others. Food and fuel inflation is also something that affects all families. So this is likely to increase wage demands faster than other forms of inflation. Sometimes supply shocks, however, are a manipulation of demand-pull inflation because the initial decisions how much to produce are made by corporations, followed by a decision to increase price now that demand is greater than supply. So you can artificially create a supply shock the more control over the market that you have. So once again, this kind of goes back to monopolistic pricing. Worker demands are often blamed for increases in inflation, as it's one of the forms of cost-push inflation in the form of labor, which is the most widespread need in any industry, so these costs ultimately do get passed on to producers and consumers. And it's also considered a form of demand-pull inflation, because as worker incomes are rising, firms see this as a way to, well, we can increase our prices and not necessarily lose that many customers. However, this is the only form of inflation, the wage price spiral, that appears to maintain the purchasing power of workers, allowing them to buy what they need despite inflation. One of the statistical justifications for the wage price spiral is a correlation between below average unemployment and above average inflation. Because the idea behind this is that because there are so few unemployed workers to draw from, businesses must offer higher wages to anyone they wish to keep or hire, thus lowering their profits if they do not inflate prices. Minimum wage increases do not increase inflation or unemployment, as has been proven by decades of economic evidence. Even the recent Nobel Prize in Economics, not a left-wing award by any means, was awarded to economists who proved that fact definitively. The left was correct about this issue for decades, but they're routinely ignored by the mainstream media and the establishment, so it doesn't really matter how many things they get right, as long as they get the main thing wrong, which is opposing capitalism. Persistent higher inflation as a result of that expected inflation theory that we discussed earlier, increases worker demands for wages, while lower inflation allows for the rich to push for arguments that, workers should tighten their belts and learn some financial responsibility. Yeah, that's what they need. Not more food in their belly and a house and everything. Oh my, no, I need another golden yacht. So the quantity theory of money. Now this one I've put deliberately last because it's the most ridiculous and it is honestly the most common. A huge number of people believe that if you print a little bit of money, you've devalued all of the previous dollars that were there. That is not really how that works. The quantity theory of money is that firm owners believe there is so much money flowing around, usually due to excessive private or public debt, i.e. money printing by banks and governments, that they increase prices without too much of a loss of demand. The idea is that each dollar printed may devalue all previous dollars by a small amount, an unknown amount, to be honest, unless paired with an equal amount of economic growth, meaning if the size of the pie grows at the exact same rate as the amount of money, well then you're golden. So, however, there is an endogeneity problem here, i.e. chicken or egg first. That's what endogeneity tends to mean. Because inflation devalues each dollar in the economy without necessarily shrinking the economic necessities demanded. So printing more money to represent the same amount of goods moving around the country is actually the correct response. And if you don't print money in order to fill the need for that demand, instead what you just have is nobody able to buy anything. Maybe you save the value of the money a little bit, but you're still getting the inflation, so basically nobody has any money now. Nearly every country that is used as an example of the dangers of printing money, lots and lots of it, like Weimar Germany, Venezuela, Zimbabwe, they all printed most of that money long after their inflation crisis began. And they probably would have been far worse off if they hadn't printed money in order to represent the same number of goods with this now devalued currency. So, I forgot about this. All of these countries had other serious sources of inflation, such as debt denominated in foreign currencies, and that devalues your exchange rate. The Germans were handing so much money over to all of the trading partners that they have in Europe that they literally were taking money in wheelbarrows whenever they were going to buy things from the store. Because essentially, the extra cost of your money being devalued on the global markets, that very quickly is going to bleed into the real costs that you face at home. So the more globalized that the global market is, the harder it is to avoid that type of interwoven inflation. However, often the easier it is to access new sources of supply, and theoretically that keeps prices down lower. So obviously, inflation is a pretty complex situation. I've tried to give it a bit of an explanation here. You can see at the bottom I have unequal exchange. That is going to be one that I put into my next video about this topic, because this one is already pretty long, and I don't really like what I've written there yet. So I want more time to think about what's the best way to talk about unequal exchange. But one of the ways is just looking at that Weimar Germany example. They're handing away so much money that the unequal exchange here is devaluing their currency and creating massive costs for the people of Weimar Germany. So this has been probably a couple of my channels. Could be Demand Better News, could be Economist, could be Demand Better Canada. I'll probably post it on all three, because why not? I hope you all have an excellent day, and stay beautiful.